Welcome back, folks. This is now a more detailed presentation talking to you about F8 audit and assurance. I'm still in the first chapter. I'm still talking about the subject of assurance and still introducing you to the process of auditing and the product of assurance. But I'm going to go now in detail into the first of the sections within the syllabus. I'm going to work my way through the syllabus reference A1 now, and that section of the syllabus is at the beginning of audit, and it starts with the concept of audit and other insurance engagements. It just gives you a little bit of a feel for how audit works. So I'm just going to use these slides in order to work my way through the syllabus, through the study guide, and to teach you audit, basically. So here we go, let's get started. So here we go, folks. As you can see, the first syllabus reference is A1A, and it asks me to identify and describe the objective and general principles of external audit engagements. Now, audit is based upon what's called the agency theory. Now, my first recording, which you probably saw just a moment ago, where I was talking about the corner shop in Bermondsey Street, that little story that I was explaining to you was a illustration of what's called the agency theory. Now, the fundamentals of audit and assurance are all encapsulated in this theory called the agency theory. And the agency theory talks about the three players that interact in the audit process. In our little story, do you remember, we had me, I was the major shareholder, I was 100% shareholder. I was 100% shareholder in a corner shop, and I had delegated the responsibility of direction down to my nephew, and that nephew was going to be my director, and then the third person that was involved in the story was you, the auditor. Now, that is the agency theory illustrated through words, but a more common way of illustrating the agency theory is by drawing up a bubble diagram. So let me show you a bubble diagram that tells the same story. So there are three bubbles that happen here. We have the principal, which means the shareholders, the primary agent, which means the directors, and then down here we have a secondary agent known as the auditor. And this presentation that I'm giving here with the bubbles that you can see right in front of you is the classic representation for the agency theory. The primary agent that's working for the principal, that's working for the shareholder, is actually the directors. You're a secondary agent. So what I do as a shareholder is I invest money into a business. I invest money, I invest trust, I invest ideas, I delegate responsibility down to the directors to give direction to the company. And the one thing that I expect in return is a report on position and performance. I hope for a financial return, but obviously if the company doesn't make money, the directors can't. If the company doesn't make money, it's my idea and they can't make money, then it's not really their fault, is it? Obviously I'm looking for a financial return, but that's what I hope for. What I demand, what I expect are financial statements, a report. Financial statements, a report on position and performance. But the thing is about the company is basically a big stack of money. And the directors are humans. And like any human, they have the potential to lie and cheat, let's be honest. So there is the chance that the directors, even though I trust them, might prove unworthy of my trust and might steal my money. And if they do so, I'm going to catch them out. How am I going to catch them out? Through the FS. But wait a second, I'm not going to catch them out through the FS because they're going to write the FS, so they're going to lie in the FS. That's where you come in as the auditor. So I delegate direction down to the directors, and I delegate audit down to you. Now, you work for me. You're independent of the directors, and you're dependent upon me. So you work for me. And what you do is you audit the FS, and you give assurance to me. And that is how audit works. That's really all there is to it. I'm just going to go back to the previous heading and just make sure that I'm comfortable with having done that, and then we'll move on. So, identify and describe the objective and general principles of external audit engagement. Well, the objective of audit is to give assurance to the principal. The objective of audit is to give assurance. And the general principle is that you work within this environment here, the agency theory. You as an auditor work as a secondary agent for me, the principal, and I delegate direction down to the directors who in return give FS. Those FS are drafted by the directors and therefore could contain lies, and therefore I ask you to audit those FS to see if they do show a true and fair view. You then give me a report to say whether they do show a true and fair view or not, and if you do say that they do show a true and fair view, you give me assurance. So there you go. That's how audit works. Welcome to audit. Let's have a look at the next slide. Explain the nature and development of audit and other assurance engagements. That's a very, very strange heading, that. It is on the syllabus, and it is worth knowing a little bit about this, but let's not overdo it. Audit is really, really, really ancient. There is evidence of audit existing from the birth of writing. We're talking, 5,000 years ago, when people first started producing balance sheets on tablets of clay 5,000 years ago on the Euphrates, in present-day Iraq, basically, on the Euphrates and the Tigris, and down there in the... It's awfully old audit. It's very, very old. What people would do is they would delegate, what kings would do is they would delegate their farms down to stewards, and those stewards would run the farm on behalf of the king, and then the king would send out auditors to go and check that those farms were running as they should be. So, I mean, we're really talking an absolutely ancient pursuit here. And I guess that's all you really need to know. It's a strange heading, isn't it? I mean, you're not going to be expected to write in detail about the birthplace of audit, but I'm just telling you so that you make sure you can address this issue. So audit is really, really ancient. The Egyptians did an awful lot of it. There's loads of evidence of the Egyptians having done audit. That would be more like 2,500 BC. You're talking pretty ancient. And then the Chinese got really into it. The Chinese are very famous for being really, really particularly good at audit. You might have heard of a philosopher known as Confucius. Confucius was a business philosopher, if you like. You know who Confucius is. Well, Confucius, or Kongfuzi, I think is properly pronounced. Confucius was originally an auditor before he started to write about philosophy and how to run your life. He was an auditor. He was 600 BC. So you're talking a really, really ancient process here. But audit, for many thousands of years, remained a thing you could have if you wanted to. As a king, you could go and ask an auditor to go and audit a farm, or you could say, no, I don't want that farm audited. A big change happened around about 1900. 1900 here in Britain, the process of auditing started to become a legal process. So shareholders were no longer being asked, would you like an audit? Shareholders were being told, you must have an audit. the idea of a company came along with the idea of an audit. So companies were invented around about 1900, and the idea of incorporating a business and formalizing the process of delegation of responsibility down to directors and writing statute and writing law, that all came about in around about 1900. And now across the whole world, there are Companies Act that are enacted in every country, and in every country it says if you form a company, you become a shareholder, you must delegate responsibility down to directors, and you must have an audit. Even if you don't want one, you must have one. And that, I guess, is a big change in audit around about 1900. The next big change in audit was around about 1980, and particularly, 1980. In around about 1980, what started to happen was auditors, until 1980, were allowed to do their audit any way that they felt appropriate. And, I would delegate down to you the responsibility to do the audit, but you could do your audit any way that you felt like doing it. That was 1980. But in 1980, what happened was that a body started to form what are called auditing standards. And now you must follow auditing standards. Now, those auditing standards were first developed in about 1980. And the reason I'm pausing for thought is there's probably a more important date, which is 1990. So 1980 was when auditing standards came into existence. In 1990, when I started audit, in 1990, there was a big flip in the culture of the way the audit was done, which was led by legislation. These auditing standards started to say that the way that you do audit is you focus on risk. The greater the risk of a material misstatement, the more work you do. So the lower the risk of a material misstatement, the less work you do. What previously used to happen in audit is people would just go through the FS line by line by line by line, and they tended to do just as much work on the top line as they would on the middle line as on the bottom line. But risk-based auditing is figure out which one is more likely to be wrong and do more work there. Identify the risks and focus your work. And that's the last big change in auditing, and that came through in 1990. So just as I was starting auditing in 1990, I got straight into risk-based auditing, but some of the people that were working around me were still doing tick-bash type auditing where they weren't really thinking about risks. So it was an advantage for me that I never learnt the old culture of auditing. I just went straight into risk-based auditing. So I don't know if I've told you too much there, but it's nice to have a little story and a background as regards F8 and audit and where it comes from. So just to recap very quickly, because a flavour is all you need, just a flavour is all you need. Audit is ancient. Audit is at least 5,000 years old. Once the first financial statements were being produced, when writing was created 5,000 years ago, auditors were auditing those financial statements, those balance sheets written on clay tablets, to make sure that the balance sheets on clay tablets told the true and fair view. So audit's really ancient. An audit didn't change very much for many thousands of years, but around about 1900 it was formalised into Companies Act, first of all here in the UK and then across the world, where you don't have a choice now. If you are a company, you must have an audit. An audit is often called statutory audit because of that. So that happened in around about 1990. The next big change came about around about 1980. In 1980, auditing standards started to come into existence, which told you how to do your audit. So in 1980, auditing standards came into existence, and then in 1990, those auditing standards changed slightly their focus. They started to focus on risk. So in 1990, you had risk-based audit. Okay? So audit is ancient, at least 5,000 years old. 1900, the invention of the company and statutory audits. 1980, auditing standards. 1990, risk-based audit. Great. Okay, that's enough. Discuss the concepts of accountability, stewardship, and agency. Well, a lot of what I've just done in my little history lesson just a moment ago is talking about the ideas of accountability, stewardship, and agency. On my next little slide, I've got those headings there just to help me to label these things out to you. Now, perhaps you do need a little bit more on these so that you have something actually written down in the context of stewardship, accountability, and agency. So here we go. Stewardship, something like this. This is the idea that directors give direction. Yeah, stewardship is not a complex idea. It's just the idea that I, as a shareholder, delegate the responsibility for giving the company direction down to these guys called the directors. And stewardship is, in fact, just an older word for directors. That's all it is. So my directors are my stewards. In return for their stewardship, they're expected to give financial statements to me. Then the directors account to shareholders via FS. So I delegate the responsibility for giving the company direction down to them. They, at the end of each year, then give me financial statements. They give me accounts to account for their performance and position that has resulted from their decisions. An agency. The directors are primary agents that bind the company. So yeah, the company is a separate legal person and has its own registration, a company's house in each individual country of the world. So it exists, but of course the company only exists in an intangible kind of sense, and the people within the business that give the company direction are the directors, and those directors not only give the company direction, but also when they speak on behalf of the company, and they bind the company into contracts, employment contracts, strategic contracts, and relationships with their suppliers and their customers. So that's it. Not very difficult. Next slide. Discuss the concepts of true and fair presentation and reasonable assurance. It's not the easiest thing in the world, this, It sounds like a piece of cake. But, I mean, they're very ancient, philosophical kind of things. And like a lot of ancient philosophical things that are deeply set into the culture of business, they're actually quite difficult to define. But I'll give you some sort of a flavour for what true and fair means. So, FS are required by law, and they're also required by law to give a true and fair view. And you, as the auditor, you're going to audit the FS to see if those FS do show a true and fair view or not. But what on earth does true and fair view mean? Now that's the problem, right? So true and fair presentation means something like this. True is true is arithmetical accuracy within the limits of materiality. Materiality is a concept that I'm going to explain to you in some detail as we'll work our way through these videos. But true basically means that the figures are right. That's what true means. So we have arithmetical accuracy. The thing is about FS, and the thing is about any form of written communication, that you can never absolutely guarantee that everything is absolutely exactly right. As you'll find in financial reporting, there's an awful lot of estimation involved. So you can't guarantee that the numbers are exactly right, but within the realms of materiality, true means arithmetic accuracy. And fair just means being honest and clear. That's all that means. So, if the FS have an honest and clear presentation, and the numbers are arithmetically accurate within materiality, then the FS as a whole show a true and fair view. Great. Reasonable assurance. Reasonable assurance. Now, here's another one that's very tricky. Let me read that to you. This is a high degree of confidence based on audit evidence that FS do show a true and fair view. When you audit FS and you give your report to me, you will frame your opinion like this. In my opinion, the FS do show a true and fair view. What you are giving me when you give me your opinion is your opinion. Your opinion is based upon your evidence. It's also based upon your experience. But the thing is about life is you can never guarantee anything. You can never guarantee anything. And you certainly can't guarantee that FS show a true and fair view. So, rather oddly, the most common way that reasonable assurance is defined is not in terms of what it is, but in what it isn't. Reasonable assurance certainly isn't a guarantee. All it is a high degree of confidence that you pass from you to me, a high degree of confidence that's passed from you to me that's based upon audit evidence that the FS do show a true and fair view, and that's all you can give. So that's what reasonable assurance is. Okay. Next slide. The next slide, of course, is the next line of the syllabus. And here it is again. Explain reporting as a means of communication to different stakeholders. Oh, this is a tricky one. This is a tricky one because it's a very broad heading, isn't it? Audit reporting. When you give your audit report to me, your audit report to me as a shareholder, your audit report will be addressed to me. Audit reports are addressed to shareholders. But the thing is about audit reports is audit reports go into financial statements, and the thing is about financial statements is financial statements go out everywhere. So not only will it be bound up into the financial statements produced on paper and sent in the post to the shareholders, the financial statements, most importantly, will go onto the internet. They will go onto the company website. And once they're on the company website, they become public information. They're also, by the way, sent to Companies House as well, where they also become public information. And, you can go to Companies House and you can actually go and look at financial statements and see the attached audit reports. But the most public way that you become public in the context of your audit report is through the internet. So you give an audit report to me, and it is directly directed at me, telling me that you think that the FS show a true and fair view. But once that audit report is bundled with the FS and put into the website of the company and then onto the internet, it becomes public information. Now, this makes it really rather tricky because your legal responsibility is definitely to me. But it's, you know, it's a bit like having a conversation in a pub. Imagine you're in a pub and you're talking to me. You're talking to me and all you're talking to is me. But you can see just out of the corner of your eye that there's someone sitting just on the left-hand side and they're listening. Now, even though you're talking to me, you can't help yourself. You're going to adapt the way that you communicate with me, bearing in mind that someone else is listening. And this is the idea in audit, is that you have to be aware of the fact that other people are going to be reading your report. And, they'd be very foolish and they probably would lose, but they might sue. So when you give your report to me, you have a primary responsibility to me, but you need to be aware of the fact that other people might read your report. It's quite a high-level concept, that, isn't it, for right at the beginning of the audit syllabus. Some of the things that I'm communicating to you now, like, for example, the history of audit and stuff like that, I'm surprised that it actually comes in the first section of the syllabus, because it's quite advanced stuff that I'm teaching you here. But there you go, that's what that is. So all you need is just an awareness of the idea that audit reports become public documents. Okay, great. Define and provide the objectives of an assurance engagement. Well, I thought I would steal a wonderful definition from the standard. There is an auditing standard, don't worry which one, that says this. The objective of an audit report, the objective of an audit. The purpose of an audit is to enhance the degree of confidence of intended users in financial statements. Gosh, yes. There you go. Intended users. The intended users are the shareholders, right? But it's kind of implied that it's not just the shareholders. You need to be aware of other users as well. It is implied in that definition, isn't it? Anyway, let's just read it again. The purpose of an audit is to enhance the degree of confidence of intended users of financial statements. Oh, that's a statement of assurance, isn't it? Enhance the degree of confidence. Right, okay, so I'm all stressed looking at the financial statements. Oh, do they show a true and fair view? I don't know. Do they show a true and fair view? Let's go to the audit report. You tell me in the audit report, you say, the FS do show a true and fair view. Oh, whew, that feels better. Right, I'll have a look at the FS. I'm now confident in the FS. So, yeah, the objective of audit is to deliver assurance. This is achieved by the expression of an opinion by the auditor on whether the FS are prepared in all material respects in accordance with the applicable financial reporting framework. Of course, across the world now, most countries have adopted international accounting standards, so we audit the FS to see that they comply with international accounting standards. Great. That's the objective of audit. Next. Explain the 5 elements of an assurance engagement. It's a very hard one, this one. I think this is really quite a tricky one, especially because the ACCA define their 5 elements effectively of 7. So it's a bit of a strange thing. Now, what I'm going to do is I'm going to show you a little slide of the agency theory again. I'm going to abbreviate it slightly. So here's the agency theory again. We've got shareholders over here. You'll remember in our bubble diagram. And shareholders delegate the running of the company down to the directors. And the shareholders invest in the directors, and the directors in return try and make money, but absolutely promise FS. But we, the shareholders, don't entirely trust the directors, and therefore we appoint an auditor, which is you in this story, isn't it? To perform a process. That process is called audit, and it's the process of going through the FS line by line by line to see if each individual balance shows a true and fair view. If each individual balance shows a true and fair view, and the FS are compiled together to show a true and fair view, then the FS show a true and fair view, in which case you tell me your opinion is that the FS show a true and fair view. And you give me a report, an assurance report. And the way that the ACCA describe the agency theory in the context of these 5 elements that the ACCA pick out is very particular to the way that they communicate. I'm not sure I would say that there are simply 5 elements. I'm not sure even they say that there are simply 5 elements. But what they do, the ACCA, when they're analysing this agency theory, is they pick out 5 things in particular. So I'll do that with you just to show you what the ACCA are expecting if they ask this question, essentially. Shareholders, directors, auditor. So 3 of the 5 elements are the 3 people involved. 3 of the 5 elements are the 3 people involved. And the other 2 that the ACCA pick out are the assurance report and the FS, the 2 reports. So the 5 elements are the 3 people and the 2 reports. Okay? So as just mentioned, there are 3 people involved in the process of audit, and there are 2 reports. That's 3 people and 2 reports. And I'm going to write these 5 elements down now. It's quite technical, this, so I want to write it down. So there are 3 people. 1 is the shareholders. 2 is the directors. 3 is the auditors. Or to be even more generic, the 3 people involved in any assurance project are known as the principal, the primary agent, delivering the primary report, delivering the primary report, and the auditors, secondary agent, delivering the assurance report. So what are the 3 people that are required for a successful contract to be made in the context of audit? Well, you need a principal, a primary agent, and a secondary agent. You need shareholders, directors, and auditors. That's a good start, but there needs to be something to be audited, and that's the report. In fact, we need 2 reports. So 4 and 5 are the financial statements and the audit report. So the 2 reports that are required are the financial statements and the audit report. Or again, being more generic, it's the primary report and the assurance report. And this is where the ACCA are a bit odd, really, because then they describe two more things and they sort of slap them on top of 4 and 5, but they're really separate things. For an audit to work, there has to be a principal, and there has to be a primary agent, and there has to be a primary report. But for the primary report to be auditable, it must be based upon standards. So I'm going to change colour there. Bit of a squeeze. It really is a squeeze, isn't it? So you can't audit FS unless they're based on accounting standards. They don't have to be international accounting standards. Obviously, that's going to be the easiest for us to understand, but they don't have to be international accounting standards, but there have to be some standards, otherwise it becomes unauditable. And the final thing is, you can't really do an audit unless you know what auditing standards you're going to be using. So based on auditing standards. So what the ACCA are trying to say to you with this rather complicated answer that I have on the board here is that in order for an audit contract to be designed successfully, there needs to be 5 things going on in the story for a contract to be drafted and for the audit to be a success. First of all, there needs to be someone who's getting a primary report and wants an assurance report. That's the principal, that's the shareholders. Secondly, there's got to be someone who's drafting the primary report. Otherwise, it's not going to work. There has to be a third person, an auditor, who's being asked in order to produce the assurance report, to do the audit. Continuing on, for an audit to be successful, there has to be 2 reports. There has to be the primary report, normally financial statements, and there has to be the secondary report, normally the audit report. Now, on top of that, for a contract to be drafted successfully, it has to be clear that the primary report is based upon standards. It's not someone just making it up off the top of the head. You can't audit, let's take, for example, Picasso's painting of a guitar, 1913. Can you audit Picasso's painting of a guitar, 1930? It's a form of communication. It's art, it's a form of communication. You can't audit it. You can give an opinion, but you can't give an opinion based upon it. It's just your opinion, isn't it? It's not a meaningful opinion, it's just what you think. The only way that things become auditable is if you can audit them by comparison to something, and that's where the accounting standards come in. So for me, that's an extra idea. So its financial statements must be based on accounting standards. And next, it's meaningless to ask someone just to do an audit. You've got to say, well, how do you want me to do the audit? What do you want me to do? And they need to have auditing standards. So what the ACCA is saying is effectively there are 7 things that need to be part of the negotiations to form a contract for audit. There are 7 things that need to be within a contract in auditing, and they've distilled them down to 5 by doubling up at the bottom there. So there's 3 people and 2 reports is what they're saying for their 5 elements. There you go. I find that one of the hardest things in F8. I find that quite a strange way of describing the agency theory. It does work, doesn't it? But it's a bit convoluted and quite difficult way of describing the agency theory. But when the examiner is asking about the 5 elements, the examiner is asking, how does the agency theory work? And as you can see, the 5 elements are based upon the agency theory. Enough said. So here comes the final slide, I think. So let's have a look at that. I've got a feeling this is the final slide. Yeah, here it is. I'm now going to talk to you about the final section within A1. So syllabus reference A1H at the end of the recording on A1. We're going to talk about explaining the level of assurance provided by auditor and other review engagements. Oh, well, that's not an easy one either. So here you go. It's just the way that audit seems to be. Sometimes you do easy things up front and sometimes you do hard things up front. And this one certainly isn't easy. So difficult, in fact, I think I'm going to skip that and jump straight down to my final slide. Yep, there it is. What do these two mean? Well, I think it's better if I just write and you see what I say. Okay. Positive assurance. Negative assurance. So there it is, 1 and 2. How do I start with this? Such a difficult thing. Maybe I'll start by just reading it to you. A positive assurance opinion is phrased something like this that you see on the board now. In my opinion, the FS show a true and fair view is a classic positive assurance opinion. A classic negative assurance opinion is, in my opinion, there is no reason to believe the FS do not show a true and fair view. Is that double negative, isn't there? There's no reason to believe that they do not. There's this double negative going on. Do not show a true and fair view. Well, we've got that on the board. Let's take a step back. See what it says there. Do you see this? Explain the level of assurance provided by audit and other review engagements. Now, do you remember that audit is the process and assurance is the product? So, I think in the earlier stories, you were the auditor, weren't you? So you were the auditor providing assurance to me, and I'm the guy that's stressed up looking at the financial statement, not sure if they show a true and fair view. So I ask you, what is your opinion? You give me your opinion that they do show a true and fair view. My shoulders open up and I start to relax, and it's a great feeling. And that emotion that you're delivering to me is known as assurance. But it isn't free. It costs money, and it costs me money. And the more assurance I want, the more work you have to do. The more work you do, the more you charge, and the more I pay. Now, theoretically, assurance products could go from 100% assurance down to 0% assurance. But the thing is about assurance products is they're intangible, they're difficult to understand anyway. So a culture has built up of just offering 2 products. You offer 2 products. You say, I will give you one of 2 products. I will either give you positive assurance or I will give you negative assurance. So if we look at those 2 again, there they are. Those are the 2 products you offer me. Neither of them are guarantees, but you can see that the first assurance, positive assurance, is substantially more than the lower one. Now, the lower one involves less work and therefore costs me less, but it gives me less assurance. The higher one gives me more assurance, but it costs more because there's more work involved. You have to do more testing. Now, sometimes you don't have a choice as regards which product you're going to have. Sometimes I have to have one or the other. But if I have a choice, I can choose between one or other. And if I have a choice, you will probably be quoting figures to me. It'll cost you this much for this one and that much for that one. And roughly speaking, this is just a ballpark figure, but there's roughly a ratio of 4 to 1. So, for example, if it's going to cost 100,000 UK pounds up there, it'll be 25,000 UK pounds down there. If it's just 4,000 US dollars for positive assurance, it'll be just 1,000 US dollars for negative assurance. But the amount of work that you will do down there will be less, and therefore the amount of assurance that you deliver is less. And you can see from the language that the assurance given by negative assurance is less. So that's what it is. You're giving me two off-the-shelf products. You offer me either one product or the other product. And that's what negative and positive assurance are. That's what positive assurance and negative assurance are. They're the two off-the-shelf products that you can offer in the context of audit. But there's a little bit more to this than meets the eye, and that is this: choice. Do you remember me talking about sometimes I have no choice? Across the world, in every Companies Act, it says that companies must be audited. But on top of that, it says the companies must be audited with a positive assurance audit report. So company FS, statutory audit, is always positive assurance. Non-statutory audit can be either positive or negative. But to be honest with you, because it's cheaper, almost all other engagements go for negative assurance. So if I flick back to the previous slide, you start to see how it works. Explain the level of assurance provided by audit. Statutory audit gives positive assurance because that's what the law requires. And other review engagements tend to go for negative assurance because that's what the client wants. That's what the client is prepared to pay for. So the client is prepared to pay less for other review engagements, so it's negative assurance. The law requires positive assurance for statutory audit. So you see how those two match up. Just put that slide in front of you again. So positive assurance relates to statutory audit, and negative assurance relates to other audit. There you go. It's quite sophisticated, that, isn't it? So getting into the politics of audit before you've even got into substantive test and control testing, well, that's the way that the syllabus is laid out. So now I have finished my first recording going through the first section of the syllabus. There are in fact 3 recordings on the syllabus within Chapter 1. So Chapter 1 on assurance has got this recording going through the first bit of the syllabus, then there's another recording going through the next bit of the syllabus, and then another recording going through the next bit of the syllabus. That's 3 study guide style videos where I talk through the syllabus, and then at the end there's 2 worked examples. As mentioned in previous recordings, the idea of these study guide lectures, these presentations on the study guide on the syllabus, is to give you a feel for audit. So they're not really supposed to be too technical. They're supposed to be not so much not technical, that's not quite right. The style of communication is me telling a story. That's what I'm looking for. So they're storytelling. These videos. The real learning goes down in the worked examples, as you will find as you work your way through these videos. Thanks very much for your patience, guys. Well done. You've made it through your first difficult video. There's another one coming up.